Trade tensions between the United States and China have now spilled over into the aviation sector, with Boeing caught in the crossfire. The Chinese government has reportedly ordered domestic airlines to suspend all incoming deliveries of Boeing aircraft and related parts sourced from American suppliers. This move comes amid a broader escalation, as the US imposes tariffs of up to 145% on Chinese goods. For Boeing, the fallout is immediate and damaging. China represents one of its largest international markets, and the sudden halt in deliveries threatens both its short-term revenue and long-term strategic foothold in Asia. Airlines that had previously scheduled fleet expansions may now turn to alternative aircraft manufacturers, disrupting established procurement plans. Financial markets are reacting accordingly. Boeing's share value dropped sharply following the news, underscoring investor anxiety around trade-exposed industries. This case highlights how geopolitical tensions are increasingly translating into tangible economic disruption. The escalating trade war between the United States and China is not confined to a single company or industry. It reverberates across international supply chains, affecting thousands of employees and billions of dollars in business. To comprehend the magnitude of this crisis, let's delve into the numbers that underscore the breakdown in aviation trade relations. As of the end of last year, Boeing's global order book comprised approximately 4,500 aircraft. Notably, over 1,200 of these orders were attributed to Chinese airlines, highlighting China's significant role in Boeing's commercial strategy. The recent directive from the Chinese government to halt deliveries of Boeing jets and suspend purchases of US-made aviation parts has disrupted this dynamic, casting uncertainty over future transactions. This move not only jeopardizes Boeing's revenue streams, but also compels Chinese carriers to reassess their fleet expansion plans. The potential shift towards alternative suppliers could have long-term implications for Boeing's market share in one of the world's most lucrative aviation markets. China-linked airlines and leasing companies account for approximately 26% to 28% of Boeing's global orders. With average list prices of $300 million for wide-body jets and $110 million for narrow bodies, these deals represent a vital revenue stream. Experts estimate that China contributes $10 to $12 billion annually to Boeing's income, excluding long-term service and parts contracts. If Beijing is now halting all aircraft deliveries, Boeing stands to lose not just billions in immediate sales, but also long-term strategic ground in Asia. Following the announcement, Boeing's stock dropped 9% to 10%, driven by both the loss of orders and broader fears of future retaliation. The escalating trade tensions between the United States and China are not only impacting Boeing, but also have broader implications for the US economy. In 2024, China's combined orders from Boeing and Airbus amounted to approximately $14.5 billion. If Beijing shifts additional orders to Airbus or accelerates domestic COMAC production, Boeing's share could be limited to $5 to $6 billion in annual revenue. This potential loss may contribute to a market capitalization erosion of $40 billion for Boeing, explaining the recent panic in the stock market. The issue extends beyond Boeing, as aviation exports are a critical factor in reducing the US current account deficit. According to official data, US exports of civil aviation equipment and aircraft amount to around $130 to $140 billion annually, with a significant portion comprising commercial passenger airplanes manufactured by Boeing, along with their spare parts and maintenance services. China accounts for approximately 15 to 18% of this market, highlighting the substantial impact of strained trade relations on the US aviation industry. A 15 to 18% drop in the US civil aviation export share, just from losing Chinese orders, translates into billions of dollars in export losses. The blow isn't just national, it's local. Boeing's supply chain touches nearly every U.S. state, with thousands of small and mid-sized firms producing engines, avionics, seating systems, and landing gear. When China halts orders, the ripple effect hits hard. These businesses depend on aircraft parts destined for Chinese buyers. According to current projections, engine parts manufacturers alone could cut 5,000 to 10,000 jobs by the end of 2025 if the disruption continues. For China, however, replacing Boeing overnight is unrealistic. Despite efforts to pivot toward Airbus and domestic programs like the C919 and CR929, wide-body aircraft like the 777, 787, and 337 MAX remain essential to long-haul routes. Phasing them out too quickly would compromise global connectivity for Chinese carriers. This is no longer just a trade spat, it's a supply chain shock with real economic consequences on both sides. China's suspension of U.S. civilian aircraft imports is a high-cost move. Replacing Boeing jets means retraining pilots, overhauling maintenance systems, and securing new spare part supplies, costing millions and taking months. COMAC, China's alternative, is not yet ready for mass production. Delays and disruptions are inevitable. Still, Beijing is signaling that it's willing to absorb short-term losses if it means striking a blow to a key U.S. industry. The U.S. has escalated tariffs to 25 to 50% on Chinese tech and is threatening more. China's response now includes aviation, marking a deeper phase of retaliation. Neither side is backing down. This is a lose-lose standoff, but both are playing to win. The stakes for Boeing are escalating fast. China was once a cornerstone of the company's international growth, with deals worth up to $160 billion on the table. If those orders now shift to Airbus or COMAC, Boeing's long-term revenue stream could suffer a severe blow. Markets have already responded. In just 1 week, Boeing's market value plunged by up to $20 billion. Another hit for a company still reeling from the 737 MAX crisis and pandemic-era losses exceeding $20 billion. Analysts warn that if China holds this line for 6 to 12 months, Boeing's delivery revenue could drop by as much as 25%. With 30,000 of its 140,000 employees tied to commercial plane production, even a 1% hit to margins puts thousands of jobs at risk. This is where economic retaliation cuts both ways. What starts as a trade barrier can end up as a domestic labor crisis. Protectionism, once hailed as a shield, may now act as a boomerang. The rhetoric from Washington is intensifying. President Trump has blamed China for walking out on the Boeing deal, accusing Beijing of weaponizing tariffs and currency policy. The message is clear: the White House isn't backing down. But trade analysts see a different risk, one that's permanent. If the standoff continues, U.S. China cooperation in aviation may collapse entirely. Industry insiders now point to an upcoming Airbus press conference, where China is rumored to unveil a new order of 150 jets. For Boeing, that would be devastating. Executives have called it their worst-case scenario. In the past 5 years, Boeing has sold over $50 billion worth of aircraft to China. More critically, Chinese carriers plan to buy over 500 planes in the next decade, with each Boeing order worth $100 to $300 million, and up to $500 million when service contracts are included. Losing this pipeline wouldn't just hit the company, it would redraw the global aviation map, shifting long-term leverage to Europe. If China cancels its current procurement plan, the result will be a significant shortfall, hundreds of aircraft that won't be delivered on schedule. Alternatives like Airbus or the China-Russia CR929 project are being considered, but neither is ready to fill the gap in the near term. Despite the risks to its own aviation industry, Beijing appears committed to sending a geopolitical message. According to analysts, China is willing to challenge itself in the short term to teach Boeing a lesson in courage. Boeing, for its part, views this as nothing short of political retaliation. The company's lobbyists are now actively engaging with Congress, emphasizing the strategic stakes and urging Washington to intervene before long-term damage becomes irreversible. Representatives have expressed concerns. This trade war will affect us not just for the next 10 years, but for the next 30 years. It could make it impossible for us to ever enter the Chinese market again. While some members of Congress advocate for flexibility on tariffs to protect Boeing, the Trump administration maintains a firm stance, viewing this as part of a broader strategy with no compromises. Consequently, Boeing finds itself bearing the brunt of a significant political dispute. In public balance sheets, Boeing's revenues from deliveries to China were recorded at substantial levels. However, the recent halt in aircraft deliveries to China has led to a notable decline in Boeing's stock value, reflecting investor concerns over the company's future in the Chinese market. Analysts warn that prolonged exclusion from China could have long-term repercussions for Boeing's global competitiveness and market share. In 2024, Boeing's revenue from deliveries to China was recorded at $7.4 billion, with projections for 2025 ranging between $9 to $10 billion. However, escalating trade tensions now threaten to reduce this forecast to near zero. Experts warn that the ramifications of this dispute extend beyond the aviation sector. Should Beijing expand its retaliatory measures to encompass other strategic sectors, a significant portion of U.S. exports could be jeopardized. China has already imposed restrictions on U.S. agricultural products, including soybeans and pork, citing health and safety concerns. Additionally, the semiconductor industry faces challenges, with new U.S. export restrictions on AI chips prompting China to consider countermeasures. These developments raise concerns about a potential full-scale trade war, which could shrink exports on both sides and heighten the risk of a global economic recession. The Boeing crisis serves as a symbol of these broader tensions, and similar conflicts could emerge in other sectors, potentially leading to increased unemployment in the U.S. and diminished investor confidence in global markets. In the current geopolitical climate, Airbus is under close observation. Company officials have stated, "We do not intend to take advantage of trade wars, but if the demand comes, we will do our best." This stance reflects Airbus's cautious approach to the escalating trade tensions between the US and China. Recent reports indicate a slight uptick in Airbus's share prices, suggesting that investors are anticipating a potential shift in China's aircraft procurement strategy. Should an official deal between Airbus and China be announced, it could further impact Boeing's market position. The ongoing Boeing-China dispute has broader implications for the civil aviation industry, particularly concerning technology, pricing, and market dependence. China's decision to halt Boeing jet deliveries signifies a substantial financial impact, considering Boeing's extensive portfolio in the Chinese market. This move not only affects Boeing's current revenues, but also its long-term strategic positioning in one of the world's largest aviation markets. The commercial relationships Boeing aims to maintain for decades to come are now under significant threat. Unless the U.S. administration backtracks in the short term, the company's share price could fluctuate further, with a market capitalization loss of perhaps $50 billion being considered not an exaggeration. Beyond the immediate financial implications, there could also be a socio-economic impact on thousands of companies in the Boeing supply chain and millions of employees and families. Boeing's extensive network of suppliers across the United States means that disruptions in aircraft deliveries can lead to job losses and economic downturns in various regions. Some analysts suggest that these developments may be part of diplomatic tactics, with the possibility that China will partially resume Boeing deliveries after a while. However, the long-term consequences of the current trade tensions could reshape the global aerospace industry's dynamics, affecting market shares, supply chains, and international partnerships. The tensions between the US and China have escalated, placing Boeing in a precarious position with a significant market at stake. Some forecasts suggest that both nations may eventually return to the negotiating table to reach agreements in critical sectors. However, if such agreements are not realized, the Boeing crisis could deepen, potentially triggering further retaliatory measures. For instance, should China decide to reduce imports of other key US products, such as agricultural goods, semiconductors, or energy resources, the trade war could intensify, exacerbating fears of a global recession. The current uncertainty is already impacting investor confidence, with Boeing's stock experiencing significant volatility. The broader implications for the global economy are profound, as prolonged trade disputes between two of the world's largest economies could disrupt supply chains, increase costs for consumers and businesses, and hinder economic growth worldwide. It is not clear whether investors should act with the hope that this tension will end soon, or whether they should run away because a new blow could come at any moment. For this reason, Boeing shares are experiencing significant volatility. Civil aviation has turned into a sharp political weapon. COMAC is gaining weight in the market. After all, China's halting of Boeing deliveries does not only mean the cancellation of an order for 100, 200, or 300 airplanes. Behind it, there are billions of dollars of technology, sub-industry, and diplomatic chess. The uncertainty surrounding the U.S. China trade tensions has left investors in a state of flux. Boeing stock has seen fluctuations, reflecting the market's sensitivity to geopolitical developments. The aerospace industry, once considered a bastion of international cooperation, is now at the forefront of economic conflict. China's decision to halt Boeing deliveries underscores a strategic move that impacts not only the aviation sector, but also the intricate web of global supply chains and diplomatic relations. This conflict places Boeing's annual Chinese revenues of $10 to $12 billion at serious risk. It also threatens to derail long-term deals worth up to $150 billion and raises the possibility of a $50+ billion meltdown in Boeing's market capitalization. For the U.S. economy, the potential loss of a country that accounts for 15 to 20% of aviation exports represents a significant blow. But the consequences may not be limited to civil aviation. Analysts warn that retaliatory actions could extend into other strategic sectors, including semiconductors, pharmaceuticals, and agriculture, amplifying the economic fallout. It's becoming increasingly clear that a new front has been opened in the U.S. China trade war, and the Boeing case is now a global reminder of just how severe such economic hostilities can become. So far, both sides are showing no signs of backing down. Beijing has publicly declared, "We are playing our trump card because of the tariffs," while the Trump administration maintains, "China pulled out of the Boeing deal, but we will not back down." The rhetoric underscores a hardline stance that leaves little room for compromise, further increasing the risk of long-term decoupling between the two economic giants. Could diplomacy break the deadlock? Perhaps, but only if both Washington and Beijing decide the cost of losing is too high. Until that point, hopes for last-minute exceptions or quiet negotiations for Boeing remain speculative at best. Right now, global supply chains and tens of thousands of workers are in a holding pattern. What's at stake isn't just Boeing's future. $150 billion in potential contracts are teetering on the edge of collapse. For the first time in modern history, civil aviation has become a theatre of geopolitical warfare. Both superpowers are deploying trade policy as a weapon, with aircraft orders and cancellations as ammunition. And with no clear off-ramp in sight, the situation could escalate even further.